All right, let's jump right in. In the next few minutes, we're going to give you a map to the market for the next couple of years. We'll show you exactly where the opportunities and, maybe more importantly, the traps are hiding. So let's start with the big question on everyone's mind. Is Wall Street basically a bargain bin right now, or is it more like a super expensive luxury boutique? The answer might seem, really complicated, but it actually boils down to one single, simple idea. In fact, you can build your entire strategy around this one core concept. It's the exact same lens that professional analysts use to cut through all the noise and see what's really going on. And that idea? It's fair value. Seriously, forget the daily stock ticker for just a second. Fair value is all about figuring out what a company is actually worth, based on its real long-term health. Think of it like this. The stock price is what you pay, but fair value is what you get. So if the price is below the fair value, you're getting a deal. Simple as that. Okay, so now that we have our compass, fair value, let's start with a 30,000-foot view. Is the entire US market on sale right now? Well, the data says yes. As of the end of last year, the whole US market was trading at about a 4% discount to its fair value. So that means, on average, stocks are just a little bit on sale. But, and this is a huge but, that 4% number is really deceptive. It's being heavily skewed by just a few mega-cap giants. I mean, if you just pull out a handful of stocks, think Nvidia, Alphabet, Broadcom, from that equation, the rest of the market is actually trading almost exactly at its fair value. This tells us that the discount isn't spread out evenly at all. So this means we have to dig a little deeper, right? If the overall market average isn't where the big sale is happening, then where are the real discounts hiding? Well, once we start breaking the market down by company size, a really clear picture starts to emerge. Large cap companies, yeah, they have that modest 4% discount we talked about. Mid caps, they're trading pretty much right at fair value. But the real story, that's in the small caps. A 15% discount? Look, that's not just a small sale, that's a major bargain. So the key takeaway here is that while the whole market looks just a little undervalued, the small cap space is where you're going to find the deepest discounts right now. But company size is only one piece of the puzzle. The next clue comes from understanding the style of investing. Are we looking at companies that are all about rapid growth, or are we looking at companies that are just plain cheap compared to what they own? And here's where it gets interesting again. Growth stocks, the ones we usually think of as being super expensive, are actually trading at a 10% discount right now. That's double the discount you'll find in value stocks. What this tells us is that analysts believe these growth companies are set to grow even faster than their current stock prices are letting on. But there is a catch, especially for all those AI-related growth stocks. Because their valuations are already so high, these companies have to deliver absolutely massive, mind-blowing results just to justify their prices. The market has already priced in these huge expectations, so the bar for what actually counts as a win is incredibly high. Okay, so we know small cap and growth are where the discounts are. Now, let's get even more specific. Let's pinpoint the exact market sectors that are basically the treasure chest right now. The analysis points to 4 key sectors that are sitting in the bargain bin. The most undervalued is real estate, trading at a whopping 12% discount. Next up is technology at an 11% discount, where you can find opportunities in names like Salesforce. Communications also looks cheap. I mean, giants like Meta are trading 24% below fair value. And finally, the energy sector just keeps offering solid discounts. Of course, for every bargain, there's usually a trap. So, which sectors are in that premium zone, trading way above their fair value? You'll want to be cautious in 3 sectors right now. Consumer defensive stocks like Walmart and Costco are seen as significantly overvalued. Financials and industrials are also trading either near or above what analysts think they're really worth. So why are financials, for example, considered overvalued? Well, it's because the market is taking their current success, which is driven by things like a steepening yield curve, and just assuming that success is going to continue forever. It's a classic case of what they call over-extrapolating today's good news way too far into the future. Okay, so we've mapped out the bargains, we've mapped out the traps. Now what? How do you actually navigate this whole landscape? Let's build a practical strategy to do just that. Here's the classic investor's dilemma, right? We all want that huge upside potential from those undervalued tech and growth stocks. But at the same time, we want to protect ourselves from sudden market drops. How in the world can you have both? The answer is a pretty cool portfolio structure called the barbell strategy. It's actually really simple. On one end of your barbell, you hold your high-growth, high-potential stocks, like the ones in the tech sector. And on the other end, you hold stable, high-quality value stocks that kind of act as an anchor during a storm. And here's how you use it in 3 easy steps. First, you balance the two ends. Second, if the market gets really hot and your growth stocks just soar, you take some of that profit off the table. And third, if the market sells off, you use the cash from your stable side to buy more of those great growth companies while they're on sale. It's brilliant. And finally, even the best map has warnings on it. So keep these key risks on your radar for 2026. A new chair at the Federal Reserve, maybe some hotter than expected inflation from trade tariffs, slowing economic growth, and some potential weakness in the credit markets. Just staying aware is your best defense.
At the end of the day, all of this data, all of this strategy, it all comes down to one powerful way of thinking. The market is like a pendulum, constantly swinging between fear, which creates those discounts, and greed, which creates those premiums. Your job isn't to predict the swing, but just to recognize when it's gone way too far in one direction, and then act with logic, not with emotion.